Hello everyone, welcome to the 78th episode of me learning how to trade in Forex. So in the last video we went through how to trade divergences. We learned the difference between a regular and a hidden divergence and how to trade each of them. So how to trade a regular divergence, and then how to trade a hidden divergence. And now we're currently doing how to avoid entering too early when trading divergences. So, below, how to avoid entering too early when trading divergences. 18th03. Let's get started. Whilst using divergences is a great tool to have in your trading toolbox, there are times where you might enter too early because you didn't wait for more confirmation. If you keep entering too early, you keep getting stopped out. You do use stops, right? And you slowly rack up losses. And you know what happens when even small losses accumulate? You end up broke. You'll end up with a divergence between your mind and your wallet regarding your wealth. Okay. Below are a couple of tricks of the divergence trade that you can make use of so that you can have more confirmation that the divergence will work out in your favor. Wait for an indicator crossover. So, tips to trading divergences. Number 1, wait for an indicator crossover. Wait for an indicator crossover. This ain't so much a trick as it is a rule. Just wait for a crossover of the momentum indicator. Just wait for a crossover of the momentum indicator. This would indicate a potential shift in momentum from buying to selling or vice versa. The main reason behind this is that you are waiting for top or bottom, and these can't be formed unless a crossover is made. Lower highs, higher highs, crossover. In the chart above, the pair showed lower highs while the stochastic already made higher highs. Now that's a bearish divergence there, and it sure is tempting to short right away. But you know what they say, patience is a virtue. It would be better to wait for the stochastics to make a downward crossover as confirmation that the pair is indeed headed down. So downward crossover. A couple of candles later, the stochastic did make a crossover. Playing that bearish divergence would have been piptastic. What's the main point here? Just be patient. Don't try to jump the gun because you don't quite know when the momentum will shift. If you aren't patient, you might just get burned as one side keeps dominating. Wait for the indicator to move out of the overbought / oversold territory. Wait for the indicator to move out of the overbought / oversold territory. Another trick would be to wait for the momentum highs and lows to hit overbought and oversold conditions. So wait for the momentum highs and lows to hit overbought and oversold conditions. And wait for the indicator to move out of these conditions. Wait for the momentum highs and lows to hit overbought and wait for the indicator to move out of these conditions. The reason for doing this is similar to that of waiting for a crossover. You really don't have any idea where momentum will begin to shift. Let's say you're looking at a chart and you notice that the stochastic has formed a new low whilst the price hasn't. So here, if you had bought just because it was oversold, and it was starting to cross over, you would have gotten burned as the pair kept heading lower. So we've got the stochastic here with higher lows. So what did higher lows mean? Higher lows whilst the stochastic showed lower lows. So it's a bullish. If you had bought just because it was oversold and it started to cross over, you would have got burned as the pair kept heading lower and lower, so it kept going lower. Lower highs indicating a new downtrend. You may think it's time to buy because the indicator has shown oversold conditions and divergence has formed. However, selling pressure may remain strong and the price continues to fall and make a new low. You would have been pretty bummed out as the trend didn't continue. In fact, a new downtrend is probably in place as the pair is now forming lower highs, and if you were stubborn, you might have missed out on this down move too. If you had waited patiently for more confirmation that divergence has formed, then you would have avoided losing and realizing that a new trend was developing. But how long would you have to wait though? Because then they say that the whole point of this was so that you catch the trend early. So, I don't know. Draw trend lines on the momentum indicator itself. Draw trend lines on the momentum indicator itself. This might sound a little ridiculous since you would normally draw trend lines only on the price action, but this is a nifty little trick that we're going to share with you. After all, it doesn't hurt to have another weapon in the holster, right? You never know when you might use it. This trick can be particularly useful, especially when looking for reversals or breaks from a trend. Useful when looking for reversals or breaks from a trend. When you see that price is respecting a trend line, so both are going down, try drawing a similar trend line on your indicator. You may notice that the indicator will also respect the trend line. Yep, so both are going down. If you see both price action and the momentum indicator break their respective trend lines, it could signal down a shift in power from buyers to sellers or vice versa, and that the trend could be changing. Both indicator and trend and price trend line should be similar, i.e. both showing upward trend or downward trend. If both price action and the momentum indicator break the respective trend lines, it could signal a shift in power. It could signal a shift in power from between buyers and sellers, and that the trend could be changing. Yep. Okay. 9 rules for trading divergences. 9 rules for trading divergences. Divergences are used by traders in an attempt to determine if a trend is getting weaker, which may lead to a trend reversal or continuation. So divergences are used by traders to determine if a trend is getting weaker, which may lead to a trend continuation or reversal. Before you head out there and start looking for potential divergences, here are 9 cool rules for trading divergences. Learn them, memorize them, or keep coming back here. Apply them to help you make better trading decisions. Ignore them and go broke. Okay. Make sure your glasses are clean. In order for divergences to exist, the price must have either formed one of the following. Rules. Oh no, not rules. Oh no, there is no rules for trading divergences. In order for a divergence to exist, the price must have either formed one of the following: higher high than the previous high, lower low than the previous low, double top, double bottom. Don't even bother looking at an indicator unless one of these 4 price scenarios has occurred. Formed one of the following. If not, you ain't trading a divergence, buddy. You're just imagining things. Immediately go see your optometrist and get some new glasses. Yes. So previous high, this high is higher than the previous, so that's a divergence. No obvious extreme tops or bottoms here, just crappy consolidation. Draw lines on successful tops and bottom, or successive tops and bottoms. Draw lines on successive tops and bottoms. I should probably name these. What do I call this? They're not glasses. Divergence must include one of these criteria. Draw lines on successive tops and bottoms. Okay, now that you got some action, recent price action that is, look at it. Remember, you'll only see one of the 4 things: a higher high, flat high, a lower low, or a fat low. Now draw a line backward from that high or low to the previous high low. It has to be on successive major tops and bottoms. If you see any little bumps or dips between the 2 major highs and lows, do what you do when your significant other shouts at you: ignore it. Draw a line from backward from one of the 4 conditions stated and to the previous high or low. It has to be on successive major top / bottom. If you see any little bumps or dips between the 2 major highs or lows, do what you do when your significant other shouts that you ignore it. So does that mean ignore the bumps or ignore the pattern altogether because it has little bumps in it? Oh no, ignore the bumps, I think. Ignore any little bumps or dips between the 2 major high highs slash lows. Connect top and bottoms only. Connect tops and bottoms only. Once you see two swinging highs are established, you connect the tops. If two lows are made, you connect the bottoms. Previous high, this high is higher than previous. No. If two lows are made, you connect the bottom. Connect tops and bottoms only. Once you see two swing highs are established, you connect the tops. If two lows are made, you connect the bottoms. Why wouldn't you do this one here? Because surely that's a lower low as well. So from here to here, that's a lower low, right? Once you see if two lows are made, oh, it has to be a successive, so it must be the one previous one, not this one, because this one's previous one would be that one, not that one, right? I think that's what it means. Connect the tops for two swing highs. Connect the bottoms for two lows. Keep your eyes on the price. Watch the price. So you've connected either two tops or two bottoms of a trend line. Now look at your preferred technical indicator and compare it to the price action. So after connecting either two tops or two bottoms with a trend line, look at the technical indicator and compare it to the price action. Whichever indicator you use, remember you're comparing its tops or bottom. Whichever indicator you use, remember you're comparing its tops or bottoms. Compare its tops or bottoms for whichever indicator being used. Some indicators such as the MACD or stochastic have multiple lines all up on each other like teenagers with raging hormones. Don't worry about what these kids are doing. Focus on tops and bottoms, forget everything else. Right, so only look at not the middle bit, only the tops and bottoms, where they peak or where they dip. Give it a little snip snip. So step 1. Step 2 is that. Step 3 has that. One, two, three. Keep your eye on the price. Whichever indicator being used. Be consistent with your swing highs and lows. Be consistent with the swing highs and lows. If you draw a line connecting the two highs on the price, you must draw a line connecting the two highs on the indicator as well. Dittos for lows also. Two highs on the indicator as well. If you draw a line connecting two lows on a price, you must draw a line connecting two lows on the indicator. They have to match. So, a line is drawn. Right, so the line drawn connecting the two highs or lows must be drawn on the indicator connecting the two highs or lows. The line drawn connecting the two highs or lows must be drawn on the indicator connecting the two highs or lows as well. So what the images say, this image connects here and here, here and here, so this one matches up to here, this one matches up to here, this one matches up to here, this one matches up to here. No, if you do draw a line you can't connect these because they're not in the same section, I guess. Keep price and indicator swings in vertical alignment. Keep price and indicator swings in vertical alignment. The highs or lows you identify on the indicator must be the ones that line up vertically with the price high or lows. Yeah, so basically the what we said in the last tip. It's just like picking out what to wear at the club. You gotta be fly and matching, yo. The highs and lows identified on the indicator must line up vertically with the price highs or lows. I think this tip should be before this tip, isn't it? Just maintain vertical alignment with the prices swing highs and lows with the indicators swing highs and lows. So, maintain vertical alignment with the price actions, highs and lows with the indicators, highs and lows. So price high matches vertically with the oscillator high, so that's that line here. Price high matches vertically with the oscillator high over here as well. So that's good. Watch the slopes. Watch the slopes. Divergence only exists if the slope of the line connecting the indicator tops or bottom differs from the slope of the line connecting the price tops or bottom. So divergence only exists if the slope of the line connecting the indicator top/bottom differs from the slope of the line connecting the price top/bottom. The slope must either be ascending or descending. It must be either ascending, rising, descending, flat, falling, or flat, which is flat. Yes. So we got ascending slope here because it's going upwards, descending slope going downwards, price confirmation, ascending slope here. So both of these are the same, so which means it's confirmed with each other or with respect to each other because yeah, they're both the same. But whereas this one's a descending slope, but this one's ascending slope, so they don't match up with each other, so there's something fishy going on. The image above provides you with two examples, one in pink and the other in blue. In the pink example, the pink lines show where divergence is present. As you can see, price made a lower low whilst the indicator made a higher low. The slope of the price line is ascending or descending or sloping down, whilst the indicator line is ascending or sloping up. In the blue example, the blue lines show no divergence between price and indicator. Both lines are sloped in the same general direction, up. Then there's a blank space here. If the ship has sailed, catch the next one. If you spot divergence but the price has already reversed and moved in one direction for some time, the divergence should be considered played out. You missed the boat this time. What we can do now is wait for another swing high low to form and start your divergence search over. So wait for next opportunity if missed. If missed current opportunity, wait for next. So if the price has already reversed and moved in one direction for some time, the divergence should be considered played out. You missed the boat this time. What we can do is wait for another. Therefore, wait for another opportunity. Lower low, higher low. So we should have bought here. If you spotted bullish divergence but trade here, you've missed the boat. You've missed the boat, Jack. The ship has sailed because you're too late. You should have done it at here instead. So, well, it's not technically a yes, but just don't. If you miss the opportunity, then don't try to get in late and try to cheese some profits. Basically, I think that's what it's meant to say. 9. Take a step back. take a step back. Divergence signals tend to be more accurate on the longer time frames. Tend to be more accurate on the longer time frames. You get fewer false signals, as there's fewer false signals. This means fewer trades, but if you structure trade well, then your profit potential can be huge. Divergences on shorter time frames will occur more frequently, but are less reliable. Divergence signals occur more frequently on shorter time frames, but are less reliable. We advise only look for divergences on 1 hour charts or longer. Advise on looking for divergences on 1 hour charts or longer. Other traders use 15-minute charts or even faster. In these time frames, there's just too much noise for our taste, so we just stay away. So there you have it, 9 rules you should follow if you want to seriously consider trading using divergences. Trust us, you don't want to be ignoring these rules. Your account will take more hits than babypips.com's Facebook page. Follow these rules and you'll dramatically increase the chances of a divergence setup leading to a profitable trade. Now go scan the charts and see if you can spot some divergences that happened in the past as a great way to begin getting your divergence skills up to par. Cool. So, divergence cheat sheet. Have you had your fill on learning how to trade divergences? Let's review. Divergence is a popular concept in technical analysis that describes when the price is moving in the opposite direction of a technical indicator. There are 2 types of divergences: regular divergence, hidden divergence. Is a popular concept in technical analysis which describes when the price is moving in the opposite direction of a technical indicator. 2 types of divergences, so we've got the regular and the hidden. Each type of divergence contains either bullish bias or bearish bias. Each type of divergence contains a bullish bias or bearish bias. Since you've all been studying hard and not been cutting class, we've decided to help y'all out, because we're nice like that, by giving you a divergence trading cheat sheet to help you spot regular and hidden divergences quickly. Regular divergence. Regular divergence signal possible trend reversal. Regular divergence signals a possible trend reversal. Hidden divergence signals a possible trend continuation. So bias, the bullish price lower low, the price action shows lower low, whilst the indicator or the oscillator shows a higher low. So it indicates underlying strength. Bears are exhausted. Warning of a possible trend direction change from an upward downtrend to an uptrend. So examples: lower lows, higher low. Bearish, higher highs. The price action is showing higher highs, whilst the technical indicator is showing lower highs. So indicates underlying weakness, the bulls are exhausted, warning of a possible trend direction change from an upwards to a downward trend. So higher highs and lower high. Wait, but this isn't line up though. That should be here, no? Why is it over here? Over here is like pointing over here. Huh? Yeah, see these line up. But this one... Let's let dodge, that is one. Right, hidden divergence signal possible trend continuation, bias, the bullish. Price shows high or low, whilst the oscillator shows lower lows. Indicates underlying strength, good entry or re-entry. This occurs during retracements in an uptrend. Nice to see during the price retest of previous lows by the dips. So higher low, lower low. These all line up. Bearish lower highs, which is what the price action is showing, whereas the indicator shows a high high. Indicates underlying weakness found during retracements in a downtrend. Nice to see during price retests of previous highs. Sell the rallies. So these line up. So lower highs are getting lower, whilst the highs of the indicator are getting higher. Whilst divergences can occur between price and any other piece of data, they are most commonly used for technical indicators, especially with momentum oscillators. Examples of a momentum oscillator include the commodity channel index, relative strength index, the stochastic, and Williams percentage R. So divergence is most commonly spotted with between the price and technical indicators. Especially momentum oscillators, so such as commodity channel index, relative strength index, stochastic, Williams percentage R. Phew, that was quite a lot to remember, isn't it? You can write this all down in your palm and look back on it whilst trading. But if you're like Eminem, whose palms get sweaty, knees weak and arms get heavy when you're nervous, we wouldn't recommend this. You can simply bookmark this page and just revisit it when you mix up those higher lows, lower highs, lower lows and higher highs. You don't want to make a wild guess whilst coming up with a trade, do you? No, you do not. Okay, divergences are not a trade signal. Divergences are not a trade signal. Please keep in mind that we use divergences as an indicator, not as a signal to enter trade. Divergence is used as a indicator, not a signal to enter a trade. It wouldn't be smart to trade based solely on divergences, since too many false signals are given. It's not 100% foolproof, but when used as a setup condition and combined with additional confirmation tools, your trades have a high probability of winning with a relatively low risk. There are a bunch of ways to take advantage of those divergences. One way is to look at trend lines or candlestick patterns to confirm whether a reversal or continuation is in order. So use divergences with other tools for confirmation. Another way is to make use of momentum tricks by watching out for a natural crossover or waiting for the oscillator to move out of the overbought/oversold region. Yep, so we looked at this. You can also try drawing trend lines on the oscillator too. Yep, we've done that as well. With these nifty tricks, you can guard yourself against false signals and filter out those that would be very profitable. On the flip side, it's just as dangerous trade against this. On the flip side, it is just as dangerous trade against this indicator. If you're unsure about which direction to trade, chill out in the sidelines. Remember that taking no position is a trading decision in itself. Oh, that's taking no decision is a trading decision in itself. And it's better to hold on to your hard-earned cash than bleed Benjamins on a shaky trade idea. Divergences don't appear that often, but when they do appear, it would behoove you to pay attention. Regular divergences can help you collect a big chunk of profit because you're able to get in right when the trend changes. Hidden divergences can help you ride a trade longer, resulting in bigger than expected profits by keeping you on the correct side of the trend. The trick is to train your eye to spot divergences when they appear and choose the proper divergences to trade. Just because you see a divergence, it doesn't necessarily mean you should automatically jump in with a position. Cherry pick your setups and you'll increase your odds of winning trades. Cool, trading divergences. When price action indicators start to move differently, it might be a signal for different behavior ahead. Test yourself on different signs and potential price movements. Let's go. Divergences can be spotted by comparing price action and indicator. What are two types of divergences? Regular and hidden. Which type of divergence usually signals a trend reversal? That's a regular one. In a regular bullish divergence, if price is making lower lows, the oscillator should be making higher lows? What kind of price divergence is formed when price makes higher highs whilst the oscillator makes lower highs? It's got to be a bearish one. Regular bearish. Why are hidden divergences called such? Tougher to spot? Nope, it's hidden in the current trend. What do hidden divergences signal? A trend continuation. In a hidden bearish divergence, if the price is making lower highs, the indicator should be making lower lows. Nope. When do hidden bullish divergences normally form? It's a continuation, so it's an uptrend. Which among these shouldn't be combined with divergence trading? Shouldn't be combined. None of the above, because they all should be used. Which among these is a part of momentum tricks and confirming divergence? Drawing trend lines on the oscillator. Both. True or false? If both price and oscillator break their respective trend lines, it could indicate a new trend is forming. True. In order for a divergence to exist, price must have formed either of the following except consolidation. True or false? It's okay if the bottoms or tops you connect aren't consecutive. False. True or false? In looking for divergences, you should focus on the tops and bottoms and forget about everything else. True. Which among the following isn't one of the 9 rules of trading divergences? Most must use stochastics only as an indicator. True or false? Divergences should be used as an indicator, not as a signal to enter trade. True. Okay, very, very good. Cool. I am going to leave this episode here. So I think we've finished the trading divergences stuff, which is very good. In the next video, we're going to be moving on to a new section called the market environment, starting with know your trading environment. So, yeah, thank you guys all for watching. See you in the next episode. Peace.